Hello friends. In the next few minutes, I am going to take you through the key events of the recent past and Kotak Mutual Fund's view on equity markets. July of 2023 saw markets maintain its upward momentum, following up on strong gains it had seen in March to June of 2023. Nifty was up by about 3% in India in July, but mid-caps and especially small caps continued their strong showing, notching up gains of 5.5% and 8% respectively. Post such strong gains in the last 4 months, for calendar year 2023, Nifty is up 9%, while mid-cap and small-cap indices are up about 20%. Most of the global markets also went up during the month. While there have been fears of global recession in the making, recent US GDP growth as well as US corporate earnings point out to renewed economic resilience in the US economy. Given this, the US Federal Reserve hiked their interest rates in the latest policy meeting. Chinese policymakers have also pledged greater support to their economy. Given these developments, crude has moved up almost 15% from its lows in the last 1 month. Indian markets reacted to Q1 FY24 earnings print as well. While it's still early days, initial trends from the banking sector point towards continued strong earnings momentum, while IT sector saw weaker than expected earnings. Consumption saw slightly weaker revenue growth even as margins saw some respite with falling commodity prices. Over the next month, as broader markets' earnings get released, one will have a better sense of the near-term earnings outlook. Monsoon distribution has been a bit uneven so far, with some parts, especially East India, seeing scanty rainfall. While monsoon onset was delayed, the last 15 days has seen significant rainfall, helping fill reservoirs across India. With regards to the flow activity, FIIs continued their purchase of Indian equities for the 4th consecutive month. Both FII and DIIs have been net buyers of Indian equities. FII bought in about 35,000 crores worth of Indian equities for the month, while DIIs were modest buyers. Given the significant purchases by FIIs for CY 2023, FIIs have been net buyers to the tune of almost 1,25,000 crores, more than offsetting the selling they did in the whole of CY 2022. With this surge in Indian equities, valuations have expanded to fair value plus zone. While headline valuations on the basis of PE etc. do suggest some near-term exuberance, on longer-term measures like price to book or market cap to GDP suggest slight overvaluation to the last 5-year averages. The last 18 months have seen some significant macro shocks. An unprecedented war in Ukraine, spiking crude about $100, significant FII selling, hike in global inflation and interest rates, etc. It does appear that the rate of change for many of these macro variables is settling down. The overall health of balance sheets of corporate India is in very good shape, and overall, we are seeing capex by corporates, which was in the slow lane in the last decade, firm up now. Capex done today is a source of future stream of cash flows and profits tomorrow. And so it's important to see the continued strength in the investment theme by corporates. The structural story of Indian equities is now reasonably well appreciated. Strong demographics, significant reforms to encourage investment and improve infrastructure, productivity enhancers like the digital stack, GST, etc., leading to greater formalization of the economy. Alongside these structural factors, the last 3-4 months, Indian equities have also been rewarded for some cyclical factors, like money moving away from China, falling energy prices and improving trade balances, etc. These cyclical factors could turn a bit adverse in the near term. Alongside, there is also elections in 2024, whose outcome will be keenly watched by market participants. Given this, we do think near-term volatility can rise. In such an eventuality, we would encourage Indian investors to be reinforced by the structural investment thesis of Indian equities and increase their allocation to equities. Do remember, a disciplined asset allocation with a focus on long-term goals is imperative, and equities will continue to be an important avenue to fulfill such long-term goal obligations. Be patient investors, and do remember, time in the market is more important than timing the markets. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.